G'day guys, welcome back to the Devon Too Good investing channel. In this video today, we have a very important video. In fact, it might be one of the most important videos that I've posted on my channel. And we're going to go over some of the key mindsets you must have to survive a bear market in the stock market. And some of the mindsets you should have so you can actually take advantage of this, see it as an opportunity, and improve your returns as a value investor over the long term. So before we get into these key mindsets, let's just check out how much the market has been destroyed. And we're going to be looking at year-to-date numbers here. So first of all, S&P 500. This is the 500 largest capped companies in the US. And you can see this index here is down 21.5% year to date. And then if we look at the NASDAQ, this comprises of the big tech companies, and they weigh heavily on the NASDAQ, and you can see that the NASDAQ index is down almost 32% year to date, which is just incredible. These sorts of drops don't happen very often, and it's been since March 2020 where we've had a drop of this magnitude. If we look over now into some individual stocks, just so you can see how much these have been wrecked. So first of all, we've got Meta platforms. We've got Facebook, down almost 52% year to date. Amazon, the great Amazon, down 40% year to date. Netflix, it's down almost 72% year to date. And if we keep going, I mean, everything's down, right? You can see Disney, almost 40% down year to date. Nvidia, nearly 50% down year to date. PayPal, down over 62% year to date. Now, what kind of mindset should you have? So I think the first key principle to understand is we buy businesses, not stocks, as value investors. We're thinking about the business in terms of their moat. We're thinking about the business in terms of the quality of their management team. We're thinking about the business as if we own the whole business and we own all the cash flows that are produced from the business. We're not buying a piece of paper that goes up and down depending on what investors feel that day based on just irrational emotions. Now, the next key principle that we must understand is as the price drops, so does the risk. And this is kind of, it goes against modern portfolio theory, which is taught in a lot of universities. However, it makes a lot of sense, right? So if you own a business and let's say you can buy it for, let's just say $100, and it produces $10 in earnings, and you're very sure it's going to keep producing $10 in earnings per year going out into the future. So you're going to be paying, pretty much 10 times earnings at $100. But let's say it drops to 50, and those earnings, you're confident that those earnings will still stay at 10. Well, you just got that same amount of earnings for half the price. So that's what I mean by it reduces risk. And as a result of reducing that risk, you're able to increase your long-term returns, because as the business eventually reapproaches its fair value, you're going to not only get the earnings growth, but you're going to get that multiple expansion that gets you back into where it usually trades at. Now, the next key principle is during times like this, this is a great opportunity to shift your portfolio into high quality compounders, as long as you buy them with a long-term time horizon in mind. And what I mean by high quality compounders, I'm talking businesses that you understand the industry, you understand how they make money, you understand the risks. You also need to understand whether they have a competitive advantage that will protect them from competitors and competition. You need to see what their margins are doing. Are the margins increasing? Are they decreasing over time? What about revenue growth? Is that in the double digits? What about cash flow growth? What about earnings growth? Are these in the double digits? And then once you establish that these businesses are high quality and they can reinvest capital back into them, which is what makes a compounder, you want to create a list of these businesses and you want to know your buy prices. And it's really important to know your buy prices ahead of time, as when the market drops, you don't want to be thinking about trying to value these businesses, because you want to do it while your mind is as rational as possible. So once you got your list, and pretty much how you're going to value these is you're going to look at how much cash can this business reproduce to me over the next 5 to 10 years, and then you're going to discount it back at your required rate of return. Now, this is up to you. It depends how aggressive you want to be. And then you want to buy significantly below what you want. And this gives you a margin of safety. So even if you're wrong in your valuation, you're still going to make an adequate return, and you obviously decrease your risk of long-term loss of capital. The next key point, you want to weigh what you get versus what you pay. And this comes back down to valuing the business. So you want to buy things, you want to buy $1 coins or bills, depends where you're from. You want to buy them for 50 cents. Because what you get is that $1 bill, but you're actually paying 50 cents. Think of it as going to the store and you know those pair of shoes are worth 50. You know you could resell them for 50, but you pay 25 for them. So obviously weighing what you get versus what you pay is obviously very favorable in terms of what you get, because you're getting $50 worth of value, but you're only paying 25. Now, the final point is you want to be patient. So you're going to value these businesses, and even in a market crash like what we're experiencing now, not all businesses might fall into your buy range, and that's okay, because who knows what's going to happen next. You're just going to be patient. If it never reaches it, it's fine. You can buy another business on your list that has reached it, but you don't want to overpay for things, because if you overpay, then there's more chance of things going wrong. The risk is higher. Remember, as the price drops, so does the risk. And your long-term returns, if you don't buy at as large of a margin of safety, your long-term returns will not be as high, and that's just simple math. You want to stay rational, all right? You want to remember that, the stock market over time, we've had World War I, we've had World War II, we've had the Great Recession, we've had the GFC, we've had 9/11, we've had the tech bubble, we've had coronavirus, and it always bounces back. And if it doesn't bounce back, well, look, what were you going to do with the money anyway? So when the opportunity arises or presents itself, you want to swing big. And you don't want to go in with, a measly, 1% of your capital, 0.5% of your capital. You want to be aggressive. You want to make the most of this opportunity, because opportunities like these to shift your portfolio into high quality compounders, they don't happen very often. So when it happens, you got to be there. You got to be willing to bet big. As long as you understand the business, as long as it's got a competitive advantage, as long as it's got a strong management team, and you're buying it at a margin of safety valuation using conservative growth estimates, well, what are you waiting for? You got to swing big. You got to swing big. All right, guys. I hope this video provided value. If you made it to the end, thank you for watching, and please subscribe and have a good one.